Welcome back, guys. In this video, we talk about the S&P 500, one of the most well-known asset and one of the longest running investment out there. We're going to see why most people invest in it, which ETF you should pick, and what makes the S&P 500 such a powerful way to grow your wealth. So let's get through it. Let's go. The main point of this video is that I'm going to show you the best S&P 500 ETF in 2025 that you should pick if you want to invest the S&P 500. But we're going to talk about many points that you should take. So watch till the end if you want to pick the right ETF for your investment. So why we want to not keep cash is that the USD purchasing power has just been getting lower each year, mostly because of the inflation. So inflation data show that the annual US inflation rate since 1975 averaged somewhere between 3 and 5%. Some year much lower, some year much higher. Over 50 years, those creeping increase really adds up. If you take $1 in 1975, it's worth somewhere around 20-25 cents in 2025 dollars. In other words, what costs $1 then costs about $5 or $4 today. This is a rough estimate, so it depends always on the year and months, but it's a rough estimate. As we can see on this graph, if you want to make a pause, we can see that the dollar value of a dollar has just been getting lower and lower and lower. So it's about 2020, so it's getting lower also each day. But dollar worth right now is around $25 in 1930. So it's kind of crazy to see that so much the US dollar lose so much value. So you don't want to keep your money in cash, in your cash account, in your bank account, and never investing it. So that's why most people rather invest in it. Quick word on the compound interest before going through the S&P 500. As we can see, if you decide to invest $100 each month at a 10% annual return, it is the average rate of the S&P 500. We can see that we can make exponential results, and those results can be crazy. So just in the first 5 years alone, the interest grows to over 22% of the portfolio total value. This is time is the investor greatest ally. In just 20 years, the interest soars to more than double the principal. So as you can see, it's one of the most basic why people decide to pick the S&P 500 is just because it's a staple asset. It's an end-of approach, and you're just building the compound interest each time till you build a big portfolio. So it's just an illustration only based on the assumption that guaranteed on the really profit of the S&P 500. So why you might want to consider the S&P 500 is that most people actually don't beat the S&P 500. Most people that invest don't beat it. Over 9 out of 10 investors fail to do better long term. So if you want to go more in the long term investment, and I recommend everyone to just go for a long term investment, it gives you a piece of 500 big US companies in one simple investment. The S&P 500 has grown about 10% per year on an average for many decades. It's an enough way to invest. Just buy and no need to pick the stock. So you don't need to worry, oh, I need to check the market, or I need to do that. So it's just an enough approach. I'm sure that if you learned about how it's a great stock, how to value stock, you can actually beat the S&P 500 pretty easily in investing and picking the right company, the right business. But if you're just going to go with an end-of approach, I'd say that for 98% of people, the S&P 500 is better than just trying to pick your own stock. Bro, seriously, trust me, it's a good investment. Just a quick word, any past result don't guarantee future return. So always be careful on this, and always be sure to pick the right things. I'm not giving financial advice. You need to always make your own decision. It's just my opinion. I think that most people would just be better buying the S&P 500 than trying to go and buy stock. Most people also don't want to learn about stock. That's what we're gonna know. That most people are just working and they don't want to learn about to invest in everything. So I'd say that most people are just better investing in the S&P 500 than just putting money in random stock and gambling. Here we have the top 10 holding of VO, one of the ETF that follow the S&P 500, but it's pretty much the same thing for all other ETF. So we have here NVIDIA, Microsoft, Apple, Amazon, Meta, Broadcom, Google, Berkshire Hathaway, Tesla, and also another one, Google. Here we have a complete list of the 500 total business that the S&P 500 hold. As we can see, it's pretty much a lot diversified, but we have a lot. The top 10 holding also have a lot of weight in the S&P 500. As we can see, technology, financial, aircare, real estate, utilities, energy. So the S&P 500 is diversified, but it touch a lot on growth with the biggest tech companies always taking the most value in it. 151 years of the S&P 500 returns. If 2023 and 2024 have been pretty much textbook for the first 2 years of a bull market, I see no reason to believe that the third year, 2025, won't be a constant as well. And he was right. We're currently in September 2025. With positive but moderate earning growth rates, we expect slower index return than have been experienced in recent months. Over the course of 2025, forecast a total return of an average of 10%. So the S&P 500 always have an average return of 10% since decade. So some year, as we can see, are in the red, some year in the green. But mostly at the end, we finish with a 10% return in the long-term run each year. Where will 2025 end up? The majority of institutions forecast a 10 to 15% return for the S&P 500 in 2025. And we're currently in September, and we have a 13% yearly return on the S&P 500. And we're only September, so 3 months left. We're maybe going to obtain a 15%. I hope so. The market's still going to grow, but we are at all-time high at $6,664 on the S&P 500. How ETFs track the S&P 500? The S&P 500 is only a list of companies. You cannot buy the list itself, but you surely can buy it, but you will have to manage, this business is not one of the 500 in the top of 500 now, so you have to remove it, buy another one. Big companies like Vanguard, iShares, and State Street buy all 500 stock for you and put them inside one fund. When you buy that fund, you only need to buy one ticker symbol, but inside it owns a small piece of every company in the S&P 500. And you will have to pay a fee on those, but since the last 15-20 years, the fee has just been lower crazy, so you're really paying a small fee to have access to all this. We're going to talk now how to choose your ETF for the S&P 500. It depends on some points. So first of all, the currency, local versus foreign, exchange costs. So it all depends where you live. So for me, I live in Canada, so I have the Canadian dollars or the US dollars that I have to pick if I want to change my money in US dollars. It all depends where you're living to. If you're living in Europe, maybe you want to buy with the tick symbol that is in euros, so you don't have to pay the fee to change it in US dollars. Priority, lowest fee with simplicity. So you might want to go with the lowest fee one, or you just want to go with the simplicity, so you don't want to go with your local currency. Style also, so do you want to have a long-term holding or frequent trading liquidity? So do you want to trade the S&P 500? Because some tick are more tradable, easier, they have more liquidity than some others. So we're going to talk about those. So here's a quick list. If you want to make pause, you have all your insert right there and there. The top S&P 500 ETF quick comparison. So the VO, this is the one I hold in my portfolio. It's from Vanguard, it's in USD, and you have a 0.03% fee on it. The liquidity is very high, best for lowest fee, USD long term. Ticker symbol SPY, State Street in USD, you have a higher fee, so a 0.945. It's highest in the trading, so it's one of the most used symbol for trading because it has the highest liquidity. It's been there for a long time. It has the highest liquidity. So if you're trading, this might be the one that you want to pick. IVV, iShares BlackRock in USD, also a 0.03%, and the liquidity is very high, also in USD. And we have VAV, so personally, I live in Canada, so I could pick this one, but I prefer VOO at the end. From Vanguard, also 0.09 management fee, so I will pay more fee to have it in Canadian dollars, and the liquidity is still high. So For me in Canada, it will be this one, but it depends where you're living. So you maybe want to take a ticker symbol that is in your currency, depending on if you want to pay exchange rate to change it in USD, or you want to keep it in your local currency. So we're gonna do now a full breakdown of each one. So the VO Vanguard S&P 500, it's a huge fund. Size and liquidity is a strong and a strong tracking. It's in USD only. Non-US investor will face currency conversion. Let me just move the camera to let you guys see the price of trading. So it's currently trading at $611 for the VOO. You can also, most instruments, to financial instruments accept financial trading, and because the S&P 500 is one of the most with the most liquidity, you can pretty much, I would say, depending on this trend that you have, buy fractional share of the S&P 500, so you can have access to it with just buying it from you can just buy half if you don't have $611 in this day of age. It's become easier and easier to invest. You don't have to have the $600 full dollars to invest it, depending on your financial instrument or online financial instrument that you're using. So the SPY, I'm just gonna move the camera, where the one that I recommend if you want to trade with it with their highest liquidity, but with the higher fee of 0.945. Now we have the graph of the SPY, so it's been there for a longer time. If you check the date, it's been there since 1993, and the VO has just been there since 2010. And the SPY is trading at a higher price at $663. Now it's time for IVV, iShare Core S&P 500 with a 0.03% fee. Massive fund, strong tracking, low tracking error, USD only, similar use case to VOO. IVV is currently trading at $666, and it's been there since 2001. So it's been a long time that it's been there, and it's also a low fee. So if we come now to a VFF, Vanguard S&P 500 in Canadian dollars, it have a higher fee of 0.9. Trading can, no FX conversion required. All US exposure primarily via the US listed Vanguard S&P 500. Now we have the graph for the VFV. So it's trading on the TSX, not the NASDAQ, so the Canadian market, the Toronto Exchange. We have the price of $163. So it's just an example because I live in Canada, but if you live in another place in the world, you might want to check one that is there for you if you're in Europe or another place. So a quick tip of rule of thumb, for the lowest fee in USD plus USD, my recommendation for you guys is VO or IVV. The easiest in Can is VFV. If you want to keep your money in Canadian dollars, you don't want to pay exchange rate or keep it in US dollars. Trading liquidity or priority, I'll say SPY. So it is the one with the highest liquidity. It's been there for a longer time. To finish the video, I'll put a quote from Warren Buffett, someone sitting in the shade today because someone planted a tree a long time ago. So compound interest is what makes the big difference in investing. So the faster you start investing, your dollar have a crazy value. If you're the younger like me, I'm 20 years old, the faster that you start investing, the faster that your dollar start compounding and create your wealth in time. If you're there for the long term, it's the mentality that you gotta have. You want to start investing as fast as possible and to keep cash in your saving account or just in your bank account without never investing it is one of the worst things that you can do, because like we did see at the start of the video, the dollar lose an average of 3 to 5% each year because of inflation. So you gotta be really careful and invest your money, because you will just losing a buy power with your money that you hold in your account in the long term. So one of my most recommendation also is that to just, if you want to go with an end-of approach, you don't want to learn about stock, you don't want to learn about which stock to pick, what's a good stock, how to read a balance sheet. It's surely easier just to buy the S&P 500 and don't worry at all. But I'd say if you want to learn, I think you can surely do better if you're willing to learn, willing to evaluate a good business. I surely think that you can outperform the S&P 500 in the long term, but most people don't, and most people don't want to learn, and they just gambling when investing. But if you just play it safe and invest in the long term, you'll just make some crazy gains. Thank you guys for watching. I hope you liked the video. Don't hesitate if you have any question in the comments. I'll take my time to respond to it. See you guys.